The broadcast is now starting. All attendees are in listen-only mode.
Hello ladies and gentlemen, I'm Joseph Novichkov, Senior Analyst at GDMfx. Welcome to our today's webinar. The topic is trend following. The content of today's topic will cover exactly what the trend is, what it means, fundamentals of the Dow theory, identifying and measuring a trend, and swing trading type of strategies. Now, ladies and gentlemen, we've all heard the saying, follow the big money, and of course the trend is your friend. In the following presentation, you will find out one of the most widely used trading techniques on the financial markets, something that most of the traders are using to identify and anticipate the next possible price move. Now, what is a trend? Charles Dow is the inventor of the Dow Jones Industrial Average, founder of the Wall Street Journal. Now, in a series of articles which later were compiled into what we know today as the Dow theory, Mr. Charles Dow identified for the first time the directional movements of the financial markets as trends. Now, more than a century after his passing, those principles are considered the foundation of technical analysis and are still used as the basis of the most powerful trading system. Now, a few of those principles are that markets move in direction which are called trends. Another principle is that there are three types of trends with, of course, respect to the direction of the movement. That's an uptrend or a bullish trend. Now that's a downtrend or a bearish trend. We also have a sideways trend, or also called a ranging markets. Now there are three types of trends, of course, which we already mentioned, and it's, of course, respectfully to their strength and priority. Now, we're talking about major trends that are visible on daily charts. They can last from a few weeks to more than a year. Now, we have a secondary trends that are visible within the major trend itself as it's in separate parts. They can last from a few days to a few months. And, of course, we have a intermediate trends. They're visible within the secondary trend as they're separate parts. They can last from a few hours to a few days. And those are the most important principles of the trends. Now, a trend, on the other hand, is more likely to continue than to reverse. Trends also advance in waves, ladies and gentlemen, just like the ocean. You know, every wave splashes into the shore and then retreats before the next one comes. Now, those retreats, ladies and gentlemen, are called retracements. Now, in the cases of up and down trends, the retracements can always be measured between 33% and 66% of the lost advancement. Now, if the retracement is more than 66% or less than 33%, then we will consider that the trend is too steep or too flat, and we should be cautious about it. For how long to follow it. Now, to identify and measure a trend, first we need to identify the major trend. After that, we need to identify the secondary and the intermediate trends. Now, the major trends are most clearly visible on the daily chart, as on the MT4 is stated as D1. The secondary trends are most clearly visible on the daily and hourly chart as well. On the MetaTrader 4, you will find out as D1, H4, and H1. Now, the final one, which are in the intermediate trends, they're most clearly visible on the shorter time frames, such as the 1-hour chart, the 30-minute chart, 15-minute chart, and so on. Now, as we can see from the chart right now, we're talking about the euro-dollar. Specifically chose this currency pair basically because it's one of the most popular currency pairs traded out there. So as we can see, when we move further into time, we have a major trend which is composed by a few minor trends, which are also called, as we already mentioned, secondary trends. Now, if we zoom into a smaller time frame, those secondary trends, we will be able to see into it an intermediate trend, and so on and so on. Now, talking about trends, let's take a look at the uptrend as a series of waves where every next high is higher than the previous high, and respectively every next low is lower, is also higher than the previous low. So as we mentioned, it's just like the ocean. When the tide is coming in, every next wave, the retracement of it is less than the previous. Now, let's take a look at the chart so we can take a few points to remember. Now, when we're trading an uptrend, for example, as you can see, it's an identified trend to the upside. As we mentioned, every next high is higher than the previous, as long as it continues. And every next low is higher than the previous low, as it continues. Now, when trading an uptrend, we always need to remember that we do not buy on highs, and we do not open any sell positions. What that means is that we always buy at lows over here. We have a buy over here, and over here. So we do not buy here, 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 and here. We always buy at lows and sell at highs. Now, how do you identify an uptrend? First, in order to draw a trend line, we would need to connect at least two dots. Now, in the case of an uptrend, those two dots would be the two lows. We will use the example as we already mentioned with the euro-dollar. So how to connect those two lows is by choosing a trend line from the toolbars on the top of the MetaTrader 4. We have a first low over here, and we have a next low over here. Now, this is one way to draw a trend line to identify a trend. And as you can see, this trend line has been breached many times into the future until the trend reverses during its up move. Now, every time on such a chart, you might need to readjust that type of a trend line to be more accurate for you. Now, we have a trend. Let's draw a little bit. We have a first low. We have our second low identified after the next high, which is this one, which is higher than the previous, as we already mentioned. Now, those 2 points are point number 1 and point number 2 for us to connect. Now, the trend lasts from here till over here. Now, this is the distance in pips, and this is the distance in time. Now, ladies and gentlemen, as I mentioned during the session a few seconds ago, we need to readjust the trend line from time to time to be at least more accurate for us so we can identify the longer run of this trend. Sometimes, as we can see, the trend line is breached, then retested, Then one more time the trend continues to the upside, which means we need to identify the next trend because this one is already over here. Therefore, we need to move our trend line further in time so we can better anticipate the next market move. We have one low here. We have our second low. To better identify it, we have our next trend continuing to the upside. Our first low from where we draw our lines, our second one over here. So there we go, we have a uptrend. And every next high, as we mentioned, is higher than the previous until the trend ends somewhere in time. And that's over here. Trend is no more. Now, something very important here to remember is identifying the trend itself. First of all, we need to measure the retracements in order to make sure that it's between the 33 and 66%. Now, to do so, we need the Fibonacci retracement. Let's put it up. From our first low to our first high. Now the retracement here, ladies and gentlemen, is precisely 33% over here on the Fibonacci, which makes it as a sustained trend. Not too steep, not too flat, a brilliant trend to follow. Now, we need to make a note as well about those two levels, the 33 and the 66% retracement. Now, once, of course, the tool is placed, we're talking about the Fibonacci retracement, those types of levels are customized for us to give us a better accuracy, up to 99.9%. By default, Fibonacci retracement does not have such levels. I've already shown in my previous webinars how we can adjust these to work for us. I can do that one more time. So once we have the tool placed, the next thing we need to do is actually adjust those levels. By right-clicking on the Fibo properties, we will find on the Fibo levels that we have a level and a description. Now the level 0.33 represents our 33% retracement, which we write into the description. Scrolling back down, we will find out that we can replace one more with 0.66, which represents as a description our 66% retracement. Now, so far so good. Once we see that the retracement is within the 33% to 66% retracement range, we can connect, as we already shown, the first and the second low to draw our trend line. This is the right way to do it. So we are connecting those dots and we have our trend line. Now, for the next one, now we know that we have an uptrend and we follow it. This is the absolute principle of it. We always buy when the price touches or is near our trend line, and we never buy on highs. Now, if you want to have multiple positions, let's consider the possibility that every time the price touches our trend line you are buying, you can use those highs to terminate your existing positions and to collect your profits. So that should be not your buying, but your closing. So that's what we have. First you buy on the low when the price touches the trend line, then you sell when it is high. Now, series of waves, ladies and gentlemen, where every next low is lower than the previous low and every next high is lower than the previous high, as we already mentioned, it's just like the ocean. Just imagine it in your head. When the tide retreats, every next ocean wave retreats less into the shore and retreats further and further back. Now, that is called a downtrend. So let's consider the possibility to have a downtrend to find out how to better anticipate the price. By the same technique, we need to identify the downtrend. Now, in order to draw that trend line, we would need to connect at least two dots. In the case of the downtrend, those two dots would be the two highs in this particular moment when we have a downtrend. Now, when we're measuring the retracement, we would once again use the Fibonacci retracement tool, and the 33 and 66% retracement rules will apply. And the Fibo will be extended between the high and the low of the wave. Basically, the technique is the same like when we were looking at the uptrends, only in reverse. Now let's consider that as a possibility. First, we have our high, then we have our low from the Fibonacci, and we need to identify whether the price is close to the 33 or at the 33% and not where near the 66 to call it a otherwise than a downtrend. So we have our price sticking around the 33% retracement here, and that means we have our two highs, point number 1 and point number 2, to connect the dots and make our downtrend. Now let's put up a trend line to see exactly how that is done by connecting it from the first high to the second high. And we have a downtrend. This is how we identified it. From the first and the second point, which we already measured from the Fibonacci retracement. Now the key points to remember here, ladies and gentlemen, when drawing an uptrend or a downtrend, when we're drawing an uptrend, we connect the lows, but when we're drawing a downtrend, we connect the high points. Now, we already know that we have the possibility of a downtrend and an uptrend. All right. How about the possibility of a sideways trend? Now, a sideways movement of the market where we do not see any higher highs or higher lows, or any lower highs or any lower lows, those types of trends are called sideways trends. Now let's identify those types of trends by using the same types of tools that we've been using so far, by trying to measure between which prices this trend is staying. We will eliminate everything that we've drawn so far, only in cases not to be making any problems with the previous drawings. Now, to consider a sideways trend, we need to measure our retracements, again with the Fibo tools. Now we have a high and a low. We need to connect those 2 points and see exactly where the price is going. As we already mentioned, the 33 and the 66% retracements of the Fibonacci are the most important percentages that we need to be looking at. So when we have a 66% and the price is very close or at it, as this particular moment, we have to consider that the trend is too flat, or as the previous on the below 33% was too steep to be sustained. That means we have a sideways trend, and those points in between, which we would be trading on the sideways movement, would be our first high and our first low. This is the distance in which we will be trading until the price decides to trade above or below those two lines. Now, we already know that on an uptrend, we never sell, we always buy. We already know that on a downtrend, we never buy, we always sell. Those types of rules does not necessarily apply to a sideways trend. Now we can sell again on highs and collect our profits on the very low. That would be the very bottom of our lines, our brackets of this price. So basically we need to observe where the price is close to the 66% over here, so we can consider our short positions and collecting our profit around the 33%. Those are the price brackets between which we would be trading, only to be absolutely sure that if the price considers to be sustained above the 66% level, that means that a new uptrend will develop in time. Or yet again, if the price decides to stay below the 33% retracement level, a new trend or a downtrend will be formed in time. That is why we always need to observe the 66 and the 33% retracement levels as our key points between which we would be trading. Sell on highs and buy on lows. This is how we can actually trade every single time on an uptrend, on a sideways trend, and on a downtrend. Now, those type of strategies are also called a swing trading strategy that we already mentioned. This is the sideways trend between the price is swinging between two levels, making new highs and new lows, new swing highs and new swing lows, which are our key points for entry on the 33 and the 66. Ladies and gentlemen, there are quite a few questions here about those trends, the identifying of them. So I need to remind you all, the Fibonacci retracement tool is a very important tool to identify a trend. Basically, yes, the question was why exactly those types of levels, 66 and 33. And those are the levels that gives us more accuracy. The answer to that is because mathematically speaking, 99.9% certainty is given by the levels of 66 and 33. Of course, as we're talking about an uptrend or a downtrend, the sideways trends, those types of certainties that we're granted by those two levels are only because we would like to limit our losses only to protect our investments. Some of the traders, I'm obligated to say that some of the traders are usually selling below and buying above the 50% retracement level. Now, the distance between the 66 and 50 and the 15 to 33 is pretty close to each other. So profits can be made, but profits will be small. Consider those two types of levels to be always at your on your Fibonacci retracement tool, so you can better understand and have a bigger percentage of certainty for your key points, respectively to the upside and to the downside. Well, basically, that is the whole thing about trend following. It's not difficult, but there are rules that needs to be followed only because if you, ladies and gentlemen, at some given point of time decide to disregard those types of rules, I'm afraid to say losses could occur on your accounts. Basically, my kind of recommendation as a professional trader would be follow those types of rules. Have it always on your screen or somewhere printed out on a side, so you can always look at it when you have a reason to doubt yourself. And yet again, we're always here to help you out with that. Now I'm going to leave you the next 5 to 7 minutes to consider a few questions if you have, and I will be back to try a few new trends to identify it. Scroll back a little bit forward and a little bit backwards so we can find new trends. But for now, from all the explanation right now, I would like to find out what your questions are, because I can see there are quite a bit of it. So let's consider the next 5-7 minutes as a QA session before we make a few tries to identify new uptrends, sideways, and downtrends. Hello again, ladies and gentlemen. I am Joseph Novichkov, Senior Analyst at GDMfx. Before going to the chart itself one more time so we can find a new trend to identify, I would like to take a slight deviation to your questions. Now, the type of the questions that I'm getting today are regarding the Fibonacci properties and the Fibonacci functions themselves. Now, why do we use it the way we use the Fibonacci to draw those types of sideways lines, and the Fibonacci line that connects at this particular moment on the chart the highest point and the lowest point, so we can measure in between the retracement possible of this price. Well, if we would like to find out what's the retracement to the upside, we always draw from up to down, from the highest to the lowest. And if we would like to see what is the retracement to the downside, we're always drawing from the highest to the from the lowest to the highest point. Now, this is the right way to use that type of tool. So far for the properties of the Fibonacci and the levels that we're usually using here, the 33 and the 66, we're also using the other levels as well. You know, some aggressive traders, I would consider myself as an aggressive trader. So basically, some aggressive traders are buying and selling in different levels. Now, the type of strategy, swing strategy that I've spoke about, to buy and sell between the levels of 66 and 33, are a little bit more conservative due to the fact I would like it to be a bit more conservative at the beginning. If you lack experience, you know, there could be some more experienced traders out there that are willing to take a little bit more risk, as well as we know a bigger risk, bigger profit potential, but also a bigger loss potential. So the way we use those types of levels, let me show you. Now, the way I use those levels, I usually sell somewhere where the price comes close to between the 166%, so basically half of the way through, something like that. And as we draw a line to the backside, we can see that the price halts exactly there. So basically this would be my entry, somewhere here and here. The idea of the other 23.6% retracement level, which is a little bit hidden behind those candlestick bars. Now, I would consider closing my position, or on the other hand, buying somewhere between the 0 and the 23.6%, which is going to be the half of it again. So drawing a line back, we can all see that even sometimes just the shadow touches this line or closes somewhere above it, which gives me a bit more distance to trade between. So basically the profit is bigger at this particular moment. But of course the risk is bigger as well, because if the price continues to the downside, we might witness a bigger loss. On the other hand, conservative traders are using those types of levels between 166 and between 23.6 and the 00, and now they're using it as a stop loss to the downside and to the upside as well. Now, if you are buying, let's say around the 33, okay, you have bought over here, your stop loss should be somewhere around here. So basically, it is still a good way to trade. It's more conservative with less profit potential, but with a smaller risk. So that is the conservative way. If a more aggressive trader should be placing its stop loss, it should be somewhere below the 0% retracement and somewhere above the 100. In some cases you can witness that the stop loss has been hit, and the losses that I would have bore at this particular moment would have been bigger than if my stop loss was here, right? Because the price already reversed, but on the other hand, in one case or the other, the stop loss would have been hit anyway. So you would have sustained smaller loss here than actually here. So this is something for you to consider, whether it's the right way for you or not. So you need to find out first what kind of trader you are. Are you a conservative one, or you're willing to take slightly a bigger risk for a bigger profit potential? That's something which you need to consider with your mentality. Basically, if you are strong enough to bear the negative trend, the negative losses for quite a bit of time without your finger twitching on the closing button of the position. So those are psychological moments which a trader needs to overcome before becoming an aggressive trader, because emotions can sometimes play a very bad role on the market, and losing your emotions and nerves such particular moments clouds your vision, and yet again it's going to be a problem for you to make the right decision. So those are the key points you need to consider first before starting a trade. Now, so far for the other questions, they're mostly regarding one-on-one sessions towards my time availability. Now, to answer those questions to all of you guys you have forwarded those questions to me. And now you can always call at the office and of course schedule a meeting with me according to my calendar. It's going to be, of course, a secretary that's going to answer the phone. If you wish to schedule something, she will tell you precisely at what time I'm available during the day. And if I'm not, time will be always made for you on the next day or the day after. So far, regarding for the recordings of those sessions, you will always be able to find it as soon as Monday or Tuesday morning after we upload it into the channel. So it can be reviewed one more time for you. For your convenience, if you have missed something or there is something that you need to remind yourselves, you can always see it there. Now, let's scroll back in time to find something that suits us best. Now, this is also according to one of the questions that I just got. How exactly are you determining that the price is going to go up? Well, basically, I can't be really certain. Okay, let's consider this as a possibility that we already know that the trend is to the upside. But let's consider that this is pretty much what we see from the chart, okay? We see a low point over here, right? We see a high point over here, okay? We see that there is a strong move to the upside. There's quite a bit of pips for a certain amount of time when you measure this couple of days. Now, what we need to do first, ladies and gentlemen, just connect the dots. Now, we just need to measure first to see whether the trend will be sustained during the time. We connect the lower to the highest point to see the possibility. We know that the 33% retracement is the most important one, and the 66 if the trend is too flat. So I'm going to measure it outside of this chart because when I scroll forward, it will not be visible. Now, what we see in time is that the price is trading and reached the 33% where it bounced off. So basically this is what we see here. This is the only thing we see. The next thing we need to do is to connect the dots one more time. So we have a low point over here and we have a new low posted. We already know that this high is higher than the previous highs. So we connect the dots and we wait for the next perfect moment so we can buy. During the time you can see spikes to the upside, new highs are posted, new lows are posted which are higher than the previous. The trend continues to the upside, quite a bit of time before it actually became invalid by breaching the trend line and going back to the downside. As we can see from over here, this is the point where everything is over. Not up here, but over here, because fake breaches of the trend line are possible during time. But what we need to see is sustained trading below it to be absolutely sure that the trend is going to reverse. And as we can see in time, the trend does reverse with a pretty strong force. So if we are apt to measure how much this trend actually reversed, we can extend the Fibonacci all the way up here, where is the final high, realizing that the price is very close or at our 66%, making it a flat trend, recognizing a new sideways movement between this and this price with pretty huge profit loss potential. Now, I'm deliberately scrolling forward and backwards to show you what we have. Now, a trend can always continue or form a new major uptrend. As you can see, first it has been traded for quite a bit of time between those two lines. Now, what we need to consider is that if a new trend forms, it needs to breach the zero level, which is over here, for us to be absolutely sure that the price is going to be sustained to the upside. And then, of course, new highs and lows are posted. We need to measure one more time and see exactly what we have. And this is one of the first trends that we actually measured over here. So you do realize, ladies and gentlemen, that there is no 100% certainty in what we're doing. It's pure science. You have some kind of a confirmation from the tools that we're using on the MetaTrader 4, confirming that the trend is to the upside or to the downside or sideways trading. As we already mentioned, this is a sideways trend. So you have your price bracketed between two lines, and you can trade it as a swing lows and swing highs. Those types of rules you need to always, of course, not break. Now, 99.9% certainty is given by the Fibonacci retracement, telling us the trend is going to be sustained above the 33% and is still flat around 66, telling us sideways range is developing. So basically, everything else that you're getting as a certainty is from the trend line that you're drawing between your two lows, or respectively your two highs if it's a downtrend. Then once breached and sustained below this line with a few days of trading, because we're looking at a 4-hour chart at this moment, that means the trend is no more, and you need to be looking at a sideways range or a new trend to the upside or respectively to the downside to be developed in time. Basically, this is the whole thing about trend following. It's not a difficult thing. Now, I had a few requests for one-on-one trainings to try this on live chart. It is possible to do that. The only thing you need to do is just phone the office and make time according to the schedules that I have with the secretary. Well, thank you very much, all of you, for the questions and for your audience today. It was a pleasure for me. Joseph Novichkov is once more my name, senior analyst at GDMfx. I will see you next week with our new webinars. Have a beautiful weekend and successful trading to all.